Many borrowers and investors just assume that the interest rate markets are binary. By that I mean higher interest rates are always bad for borrowers, the economy, and the stock market, and lower interest rates are always good. But that's just not the case. Some moves in interest rates can be good for some types of stocks and bonds, while other moves in interest rates can be good for other types of stocks and bonds. You really need to know how interest rates are moving, which interest rates are moving, and at what rate interest rates are moving to really determine whether that's supposedly bad or good for the overall market and particular stocks. What we're seeing right now is that the long-term end of the yield curve has been flat to slightly lower over the past couple of months, while short-term interest rates and short-term tracking futures, such as Eurodollar futures, are seeing an increasing amount of the movement. That's because the Fed is now doing what I've expected it to do for some time, which is follow the long-term part of the bond market and hint towards raising interest rates itself. We've already seen $30 billion lopped off the quantitative easing program. Next up, as that dwindles down to nothing, we'll see actual short-term interest rates begin to rise. So more of the action in the interest rate market will be happening at the front end or short-term part of the yield curve rather than the long end. Again, the shape of the yield curve, meaning what it looks like on paper when you map out the different yields of everything from 3-month Treasury bills on out to 30-year Treasury bonds, can impact different stocks and different types of loans differently. When long-term rates are going up, but short-term rates are remaining anchored, for instance, you'll see 30-year mortgage rates go up, and you'll see things like real estate investment trusts suffer, even as banks do fairly well. But as you see the action shift towards the front end of the curve, you may see things like home equity lines of credit eventually see their interest rates go up, along with credit cards, while 30-year mortgage rates have already reflected that increase earlier in the process. So again, you really need to know how the yield curve is going to move, which interest rates are moving, and at what rate they're changing to determine whether or not that's going to be bad or good for you as a borrower, saver, or investor. This is Mike Larson with Money and Markets.